Hi viewers. Hi. Hi everyone. This is Dr. K. Pradeep Reddy, Associate Professor, Sales University, Bhopal. Would like to bring to you what are the different types of derivatives instruments that are available in the market. In the previous video, I have given you about a brief introduction about what the derivatives are. And in this video, I would like to bring you about what is a forward contract, what is a futures contract, and other terminologies that are used in these contracts. So let us look into this. So what is a forward? So forward, or we can call it as a forward contract also. A forward is a contract in which one party commits to buy and the other party commits to sell a specified quantity of an agreed upon asset for a predetermined price at a specific date in the future. So that means two parties coming together to enter into the contract. For example, let me say about a farmer and a trader. These two people come together at one place and they will be entering into the contract saying that a farmer will say that he will be supplying wheat in another next 6 months. And both of them come together to one contract and they will discuss upon that contract, and the price also is decided today itself. So that is a forward contract. So a forward is a contract in which one party commits to buy and the other party commits to sell. So here the trader is committing to buy and the farmer is committing to sell a specified quantity of an agreed upon asset for a predetermined price at a specified date in the future. The price is also determined today itself, and the specific future date also is specified today itself because it should be done and it should be delivered on a specific date. And it is a customized contract in the sense that the terms of the contract are agreed upon by the individual parties. And hence, it is traded over the counter exchange contracts. As we have seen, what is an over the counter exchange traded contracts? They are unregistered contracts and they are free of fall of price of contracts. And let us see the example here. Here, the farmer is agreeing to sell 500 kgs of wheat at rupees 40 per kg after 3 months. And the bread maker who is the purchasing the contract after 3 months will be entering. Both the farmer and the bread maker enters into the contract today itself, and after 3 months, farmer has to supply 500 kgs of wheat and the bread maker has to give rupees 20,000 to. If both of them performs the contract, automatically there is no need for violation of the contract also. So this is a very good example, so that I think that everyone can understand through this example. And what is the risk in forward contract is the credit risk, the operational risk, and the liquidity risk. So what is the credit risk is, does the other party have the means to pay? That is the person who is entering into the contract, the trader, can he has the real credibility to pay the contract? And the operational risk is, will the other party will make delivery? That is the farmer in the above example. Will the other party accept a delivery? Because according to the quality given, will the delivery person, will the farmer will supply is a question. And the other person will take the delivery exactly without any violation. And the liquidity risk is in case either party wants to opt out of the contract, how to find another counterparty is a very big difficult aspect in this forward contracts. And now let us see the terminologies used in these contracts are long position, that is used for the buyer, short position is for the seller, and spot price is the price of the asset in the spot market, and the delivery or the forward price is the price of the asset at the delivery date. So these are the general 4 terminologies used in these contracts. That is, the long position will be taken up by the buyer, short position will be taken up by the seller, and spot price will be the price on the market, and delivery price will be the price of the asset at the delivery date. And now with this, I hope that you have understood about a forward contract. And now let us see what are futures or futures contracts. A future is a standardized forward contract and it is traded on an organized exchange. And the standardizations are quantity of underlying asset, quality of underlying not required in financial futures, and delivery dates and procedure and the price codes are important in these futures contracts because they are exchange traded contracts. So a future is a standardized forward contract and it is traded on an organized exchange, and the standardizations that it is having are quantity of underlying, quality of underlying, delivery dates and procedures, and the price codes are priorly intimated in these contracts. And the futures contracts, this is the best example I can give you so that you can understand it very easily. So here ABC are the 3 parties, and you can see the spot price that the day 1, day 2, and the day 3, that is $10, $12, and $14 here. And in the given example to you, you can understand who is in profit and who is in loss. So long call and short call in the dollars given here so that we can understand it best and we can act according to the positions. And next, let us see what are the types of futures contracts. That is, first one is stock futures trading, which is deals with shares, and commodity futures trading dealing with gold futures and crude oils and other commodities, and index futures trading dealing with stock market indices. As the index futures are very important and very crucial in the futures contracts, majority of the investors are dealing with index futures because it is very simple to understand and to enter into the contract and come out of the contract by having a profit transaction. And next, how to close a futures position is most futures contracts are not held till expiry but closed before the date, because if they held till expiry, they are generally settled by delivery. That is 2 to 3% of the transactions are being done in this manner. And by closing a futures contract before expiry, the net difference is settled between traders without physical delivery of the underlying. And the terminology used, let us see here, are contract size, the amount of the asset that has to be delivered under one contract, and all futures are sold in multiples of lots, which is decided by the exchange board. And let me give you one example. If the lot size of Tata Steel is 500 shares, then one futures contract is necessarily 500 shares. And the contract cycle is the period for which a contract trades. The futures on the NSE have 1 near month, 2 next 2 months, and 3 4 months expiry cycles. This is the contract cycle under which an investor can understand in which cycle he wants to sit for. And the expiry date will be the usually last Thursday of every month or previous month. If Thursday is a public holiday, it will be cleared the next day. So these are the terminologies that are used in the futures contracts, and there are also like a strike price and the cost of carry. What is the strike price? Is the agreed price of the deal is called the strike price, under which both the parties have entered into the contract. And the cost of carry is the difference between strike price and current price, because in market we have 2 prices, and according to that, when we are carrying a contract, we have to see the difference between these strike price and the current price so that we can understand whether we are in a profit mode or in loss mode. so that all the viewers of this video can understand that you have understood very well about what is a futures contract, what is a forward contract, the terminologies used in these contracts. So thank you everyone. Bye bye. Let's wait for the next video. Sure, we'll be back soon.